Let's go ahead and share some announcements. So we're having an exam next Monday. Chapters 5, 6, 7, 8, and 13, the ratio stuff. We're gonna have a quiz on ratios today. On Friday, come with questions. We're still gonna do an Excel review. There'll be a 10 or 15 minutes worth of Excel. But if there are more questions than a time period, you won't do any Excel. I want to get your questions on the chapters above to help you review the content of what we're after for Monday's exam. Make sure to mark your calendars, April 15th for Career and Alumni Night. It's going to be on the same Zoom channel. And we have a panel of alums coming back talking about how they got to where they are. And they might be worth having a chat or asking questions to help you get to where you want to go. And finally, for extra credit presentations, if you have some to get full credit, you obviously need to present. Get your write-ups to me, both on the same day. So let me know at the beginning of class. It's coming, tomorrow's April 1st. We're already at the home stretch. Another month to go. So if you have extra credit projects, activities coming up, let me know, keep me posted, and we will go forward from there. In the meantime, let's start with a quiz. There's a quiz posted. You're welcome to go online directly to connect. You're welcome to go into Blackboard. It's a 5-question ratio quiz. Take it away. All right, so we'll continue onward. Looks like overall pretty good results on the quiz. Let's go forward. You'll have full access to results after midnight tonight. So we're going to go over and take a look at our over to depreciation. We're going to finish off on intangible assets. We're going to finish off on makers and modified accelerated cost recovery system for tax purposes. And we'll review quickly the declining balance method. So this is an accelerated method. We mentioned that we do not deduct the salvage value out of the gate. Straight line method, we do. Units of production, we do. But when we go over to double declining balance, triple declining balance, 150% declining balance, we're not going to deduct the salvage value out of the gate. We will keep that in mind though at the end, because we can't have our NBV, our net book value, go below the original price less all the accumulated depreciation. Can't go below what we have as a salvage value. So looking at this, straight line was pretty straightforward. Divide by the number of years, 20% a year in this case. When we do double declining balance or 200% declining balance, we just double the 20%. If we did 150% declining balance, instead of 20%, we multiply by 1.5 and get 30%. If we did triple declining balance, we multiply that 20 by 3, we triple it to 60%. And that's again a percent of the remaining book value, the net book value. So we're going to deduct accumulated depreciation and come up with a new base to calculate, in this case, the 40% every year. So we look at what the schedule looks like. You can see that the first year on the full 10,000, we take $4,000, 40%. On the second year, our remaining book value is 10,000 minus 4,000 cumulative depreciation for a book value at the end of the period of $6,000. That's what we use to calculate our 40%, not the original 10,000. So 4 times 6, 24, we get $2,400 as the depreciation expense. And then the final year, the 5th year, we go through and we adjust our depreciation expense so we get down to the net of the asset value, which will be the salvage value. Can't go below 1,000, no matter what the 40% says. So we go in and say, yep, we're going to plug the number to get us to the $9,000 an accumulated depreciation expense, $1,000 net book value. We're going to plug a number in. All right. We compare the depreciation methods. Straight line is the same amount every year. Although we're going to talk about in a minute, what happened if we purchase the asset July 1 or April 1? or December 1? Do we take a full year's depreciation? Well, the short answer is no. And we'll play with that a little bit in a few minutes. We've got a units of production. That is going to be based, it's an extra calculation. We have to go one more step and say, well, how many miles did we drive? How much did we use machine hours? So we have to go and calculate that, having already come up with a factor that we're going to determine dollars per mile or dollars per hour. So again, dollars in the numerator, and then the units, hours, miles, like miles per gallon. Miles in the numerator, gallon in the denominator. Price to earnings ratio, price in the numerator, earnings in the, or net profit or net income, all the same number, denominator per share in that case. Now our double declining balance, we're still going to get to the same total 9,000 cumulative depreciation. You just get there much faster. All right, we're going to take a look at depreciation. We talked about makers, modified accelerated cost recovery systems. IRS likes to use makers. Makers is not GAAP though. Hey, wait a minute, if it's not GAAP, how can we do it? Well, we don't have to follow, we can have 7 sets of books. Fair market value books, GAAP books, IRS books, 2 other sets of books that include some numbers, don't include others. Whatever books we want, but we need to be consistent. For the IRS, they don't want our GAAP books. They don't want any other books. They want tax basis books. SEC, they want GAAP basis books, even if you have other tax books that you maintain, and that's okay. You have something called deferred taxes, which we get into financial reporting classes. So we're looking at this and saying, okay, I'm a small business. I'm going to prepare my books the way the IRS wants them. Do I have to switch over to GAAP? Well, if you're not publicly traded, yeah, you can go non-GAAP books. You can do IRS books. As a matter of fact, you're probably going to keep the depreciation method that the IRS uses as your method for your books. It's easier to have one set of books if you're a small business. You don't need to mess around. It's tough enough getting one set of books together. Trying to mess around with 2 or 3 sets, you don't have to worry about that too much. But let's go over to partial year depreciation. And we'll think about partial year depreciation for a minute. What happens if we buy that asset July 1? Well, we've only had it for 6 months. In this case, we bought an asset on October 1st. October, by the way, so October is the 10th month, December is 12th, 12 minus 10 is 2. But we're doing 3 months? Well, you use your fingers, count it. We got all of October, all of November, all of December. Okay, so we got 3 months of depreciation. As you can see here, we take 3/12 times normal depreciation. Next year, we'll take 9/12 for the first 9 months and then 3/12 the next 3 months, which in a straight line is going to be equal to our annual depreciation. But this year, we're only taking half. I'm sorry, a quarter, 3 months. So instead of the $1,800, we're going to take $450 out of that. Next year, we'll take the full $1,800 on a straight line basis. Let me talk about tax depreciation. Okay, we talked about depreciation with tax. It's going to be in the form of what we call makers. So we have makers depreciation, modified accelerated cost recovery system. And they typically use a declining balance method. They might use 200%, double declining balance. They might use 150%, half declining balance. And they use something called a mid-year convention. Mid-year convention is not a party. It's not a get-together when we go out and grab a couple of drinks and talk what we want to talk about. A mid-year convention says, well, I don't care if I got a July 1, December 1, February 12th, April 30th. I was going to say 31, there's only 30 days in April, so we want to make that mistake. Or October 5th. We will take a half year's depreciation. So the first year depreciation is 1/2 of the normal depreciation. It's double declining balance, we'll take half that amount. Then beginning that next year, we'll take the other half and plus half of the new amount we calculate for double declining balance or any declining balance. Straight line, again, they don't use straight line for the IRS for the most part. So this mid-year convention makes life easy. You don't have to calculate the number of days you own an asset. Just think about it. Well, let's see, did I buy the car on December 11th or December 14th? Well, it was delivered on the 18th, but when did I buy it? Well, you don't need to mess around. Half a year's depreciation, done deal. So that's a pretty clean approach. Sometimes they use a modified mid-quarter convention for some companies if they buy lots of assets to be a little more accurate, more reflective of depreciation. So this makes a great case if you are looking for tax deductions in the current year and you're going to buy a car in January. Hey, you buy it in December, you get a half year's depreciation on it. Actually, with the IRS, there are some other benefits. There are certain dollar amounts of assets that you buy. You can take 100% depreciation in the first year. Talk to a tax accountant. And that's why you need good accountants, good lawyers, good coaches, good business people around you that have a good idea of what's going on. All right, so let's go back and we're going to stop share here. Actually, do a new share and go back to our. So let's talk about changes in estimates. What's a change in estimate? Well, I bought this truck. I thought it was going to last 5 years. After year 3, I say, you know what? It's going to last 7 years. My original 5-year estimate was not real accurate. I've got a better estimate now because I've got the truck and it's been going pretty well. It looks pretty good. And it looks like it's going to last a longer time. So what do we worry about? What's our concern with that? Well, we've got 2 ways we could treat it. We could go in and say, you know what? Go in and we'll talk about this now. So I got an asset, let's say a truck, and I bought for $100,000. I projected that I was going to have 5-year life. I'm going to assume no salvage value. Let's make the numbers easy. So what do I take? 5-year life, $100,000. Looks like to me it's $20,000 a year. After 3 years, you say, oh, this truck's in good shape. Revised estimate, 7-year life, total life. That's 2 more years than I originally thought. I've got a couple of options. We can go back to year 1 and say, oh, I got a 7-year life, divide my 100,000 by 7 years and restate my financials for 3 years ago, 2 years ago, and this past year. Or I could prospectively adjust this year. So what's already happened? I've already taken $60,000 worth of depreciation. I've got 100 minus 60. I've got a net book value. Net book value, NBV. So for my additional, let's see, I'm in year 3. I've got year 4, year 5, year 6, year 7. I've got 4 more years. I'm going to, from here on out, take 10,000 per year. I was taking 20,000 a year. I already depreciated 60 grand in 3 years. I'm not going to go back and restate my books. If you had every asset that you revised, that you made a mess of, and you revised it and had to go back, your books would be constantly changing, and it would just be, it's not worth it to go that far. But you're at a point right now that says, well, I'm going to get 4 years total left in this thing. I'm going to recalculate my depreciation for 10,000 a year. So pretty clean, pretty easy. Hopefully that makes sense to you. And we're going to be not retrospectively, not going back in time, but prospectively from now here on out. All right, let's go back and share some more. To our spreadsheet, or PowerPoint rather. So we have our estimate over the life of an asset. There's new information. Original estimate was not quite accurate. We're going to make the adjustments accordingly. So here we go. Book value, revised salvage value, if we have one, revised useful life. And the way we calculated, we came up to 10 grand a year. Here, they're going to come up to 1,500 bucks a year. But there is a new salvage value we also associate. Let's talk about a term called impairment. Impairment, what's interesting about the term is means the asset lost value, impairment then, It lost value that was never going to recover. Let's say I had a CAT scan machine. I paid $1 million for it, say 5 years ago. It took 3 people to operate. It's got $100,000 a year in operating in just electricity. And it's one of those closed CAT scan that's claustrophobic. And now, 3 years later, 5 years later, the new machine only takes 1 person to operate. And it's an open CAT scan. And it doesn't take $100,000 electricity, it takes $1,000 electricity to operate a year. Originally, you thought that other machine would last 20 years. And physically, it probably could. But what do we do with that $1 million machine on our books that we just bought $300,000 machines to replace them? Because we happen to have 3 techs and we have a volume of business that we need to do a lot of CAT scans. And we're not going to, well, maybe we'll save this for a backup, for emergency. I mean, it's going to cost us a lot of money to get rid of it. So have someone come in, take it, salvage it, trash it. Maybe we can ship it overseas, underdeveloped country, that maybe they can take advantage of it. But the reality is, this $1 million machine that we thought was 20 years worth, we've been depreciating $50,000 a year, isn't going to last us 20 years. It's useful. Useful life is not 20 years. It lasted 3 years. Thank you very much. But now we get new machines to replace it. So we're going to write down that asset, in this case, to 0. What I was saying was true. So we have our accumulated depreciation that's going to get hit. We'll credit that. In this case, the remainder of the $1 million or whatever gets maxed out. And the impairment loss, which shows up in the income statement. So we're impairing the assets like an expense, debit the expense, debit the loss. So we lost that machine, can't use it anymore for what we want, and it's not worth anything to us. So we are impaired, because if somebody bought your company, wouldn't they want to know what assets they're getting? And if you say, hey, I've got this $1 million machine, congratulations, you just got it. Why aren't you using it? It's too expensive to run. We're not going to use it. We've got these other machines that are so much more efficient, don't take a whole bunch of personnel. So why is it still on the books for $800,000, $700,000? It's not worth anything to me. It's not worth anything to you. You should have taken an impairment loss. You should have written it down. That's what GAAP says, and that's what we do. So that's what impairments are. And assets aren't always what they used to be. You total a vehicle. You got a car. You got a truck. It gets totaled. You have a loss on the vehicle. That vehicle is obviously impaired. Now, a truck doesn't drive under the influence, but it does lose value. Decline in the fair value of an asset required writing down to its current fair value. Right, so maybe it's all beat up, dented, but it still runs. You can still use it. It's not worth nothing, but it's not what it used to be. Let's take a look at revenue expenditures versus capital expenditures. Revenue expenditures show up on the income statement. Capital expenditures show up on the balance sheet. And you've been reading about fixed assets. I'm going to ask at this point in time, and you're not being graded on this because we haven't really reviewed it, but you probably should have read it by now. Is an oil change considered a revenue expenditure or a capital expenditure? Should an oil change go on the books on the income statement, like a revenue expenditure, or should it go on the books as an asset, capital expenditure? So in the chat, go ahead and type revenue or capital. Everybody gets to play. That's my tennis question for the day. Revenue or capital for oil change? Looking good. Everyone's got down revenue. All right. Actually, the quiz, if you missed the quiz that was at the beginning of class, it is open until midnight tonight. I just checked message. There was a message. Yes, you're supposed to be doing something. All right. And actually, let me go ahead and share the announcement because I guess not everybody here when I did the announcements. The announcements include an exam on Monday and then come with questions on Friday, as well as April 15th is a career and alumni night. So we have folks coming, alumni, probably got at least 20 alums coming, and hopefully at least that many students, if not more. And hopefully you'll be those students participating. Learning more about your career. But let's talk about revenue and capital expenditures. What if you have a truck and you drop an engine in it? Or you got a building and you add a roof to it? You think that will extend the life of your truck or of your building? Most likely. Probably good roof last 25, 30 years. Another engine should last 5 or 10. How about an oil change? Does that extend the life of your vehicle? Well, yeah. If you don't make oil changes, you're going to have a very short life on your vehicle. But that's not considered a benefit on the long term. It's not going to be capitalized, put as an asset, put on the balance sheet. It's going to be expensed in the current period. So that's why oil change, which you all got right, is a revenue expenditure, not a capital expenditure. All right, so we keep going. Again, ordinary repairs. Okay, pop some tires on that same vehicle. Pretty ordinary. Tune up, pretty ordinary. Or extraordinary repairs and betterments. All right, so I put a ladder rack on my truck. In addition, I put a winch and whatever else I want on my truck. So that's an improvement. Even if the truck's 2 years old, it's still going to last the life of the truck, hopefully. And again, being more than a year would be considered capital expenditure. And here's what we do. In an ordinary repair, debit the expense, credit the cash. For an improvement, we debit the equipment, the asset, and credit the cash or the payable. Any questions on that? Are we making sense? So what happens if we dispose of a plant asset, meaning we sell it? We get rid of it. We write it off. We give it to our kids. We give it to employees. By the way, just because you bought a Porsche 6 years ago, it's fully depreciated down to zero. You own the company, you decide to gift it to one of your kids or to yourself. There are tax ramifications of that gift of a Porsche because it has value. Even though it's fully depreciated, the books say it's worth zero. But you and I know that if the Porsche is in running condition, it's probably not worth zero. It's probably a pretty nice gift that any kid would love to get. I'd love to get one myself. So you look at that and say, good, the $0 coming to me, but the IRS is going to walk in there and say, you know, that car still has $25,000, $30,000 in value. That's income. Congratulations, you've earned that. Add that to your paycheck. Pay taxes on that, please. But the IRS has a say. Something called an arm's length transaction. Give yourself a 1% loan when the market rate of interest is 2 to 4% for a mortgage these days. Well, company's giving me a 1% loan. That's not an arm's length transaction. You made the decision for the business to give you a loan. You're getting some benefit. That extra interest you're not paying is called income. Congratulations on your wages. But what happens when we sell an asset? Well, first of all, let's talk about getting rid of an asset that we don't sell. Okay. Let's have a fully depreciated value, something that we get rid of. Let's see over here. A second. All right. We discarded an asset. We didn't get paid anything. We got zero cash. Matter of fact, we just trashed it. So what happens? The whole idea when you dispose of an asset, you take the depreciation up to the day you dispose of the asset, and then you make some calculations. You say, okay, what is my cumulative depreciation of the asset? So far I've got $6,500 on this asset. It's got a credit balance, I got to debit it to clear it. I've got equipment of $8,000, that's what I originally paid for it, went on the books for $8,000. No cash came in the door. So I will calculate my loss here in case $1,500, no cash changed hands. Now, if I were to go further and say, well, maybe I got some cash. So here's our equipment. And this time we got, sorry, back up a little second. Let's go down here. If cash is greater than net book value, or net realizable value, the book value of the asset, we have a gain. Cash is less than the book value, we have a loss. And if there's no cash, whatever the book value is our gain or loss. So we know what the cash is. We know what the accumulated depreciation is. Those are going to be two debits. And we have the asset cost. It's a credit. We've got to plug either a credit or debit here of the gain or loss. Let's say we sold an asset for some cash. First, we take the depreciation on the machinery. Cost $9,000, has accumulated depreciation of $9,000. Okay, it was discarded. No gain, no loss. You clear the accumulated depreciation, will clear the machinery. Now, the only time you can take it off the books is when you get rid of it, when you sell it, when you take it to the junkyard, trash it, give it away, say someone come and get it, put it on the curb. But what happens is we show that we take our depreciation expense up to July 1 here, and as of July 1, we've got a 6,500 or 8,000, we calculate our loss. But how about if we sell it at book value? If we're selling the asset, we get cash. We take our depreciation, again, in this case to March 31. We have $16,000 in equipment. We have $13,000 in accumulated depreciation. Whatever cash we have, there's our $3,000 cash, we're good to go. But what happens if we got $4,000 cash? If I was here and I got $4,000 cash, I have 4 plus 13 is 17, I have 16 here, I'd have to put 1K as a credit. That would be a gain. Gain on sale or disposal of asset. What happens if I only got 2,000 in cash? If I got $2,000 in cash, I would still be out of balance. I have 13 plus 2 is 15, 16. I have $1,000 here. Debit balance, loss on sale or disposal of asset. So I like using a journal entry for my plugs. I see the asset, I see the accumulated depreciation, I see the cash, and I know I either debit the loss or credit the gain. Now you could say, oh, I could do this, 16 minus 13, I got $3,000 net book value. And if I sell it for above 3, it's a gain. If I sell it for below 3, it's a loss, and you are totally right. If you're comfortable doing that, you get a winner. You calculate the gain or loss. I like calculating the gain or loss basically by looking at my journal entry. Personally, what the choice is yours. So if we sell above book value, so we know we got 7,000. We know we have a 13,000 accumulated depreciation. We know we got 16,000 that we got to worry about. And we know that our total debits is 20,000. Our total credits without the gain or loss is 16,000. So we know we need $4,000 plugged, which is a gain. Credit the gain. And if we sold it below book value, you'd have to go in and say, well, I know my accumulated depreciation. I know what I paid originally. I know the cash I got in the door. To balance this out, I got $500. 25 cash, 13,000 accumulated depreciation. My net book value is still 3,000, but I only got 25 in cash. So you can figure that out that you had 500 in a loss. And you're on your way. Question on that? I'm going to quickly go through depletion. We've got depreciation expense, we have depletion expense, and then we're going to talk about amortization expense. I'll spend a little bit more time there for intangibles. But our depletion, maybe we bought a coal mine. Maybe we have oil in the ground. Maybe we have a gold mine, we have gold in the walls. So we're going to calculate cost minus salvage value divided by units, so dollars per ton in this case. Although if it was gold, it'd probably be dollars per ounce, not probably dollars per ton. But depletion expense, debit the expense like depreciation expense, and we credit accumulated depreciation. Accumulated depletion. So yes, depletion is accumulated against the value of the asset. And the natural resource disappears. We're using it up. If we have to buy assets, if we have to buy drilling equipment, we don't tie it to the land or to the mine itself. It's an asset like any other asset, machinery, equipment, to be depreciated accordingly. But I want to spend a few minutes on intangibles. Let's look at intangibles. All right, so we've got a building. We've got a computer right here. We've got tables, desks, and chairs. Those are tangibles. You can touch those. Intangibles aren't the things you touch. Intangibles are pieces of paper, rights to things. Matter of fact, if you think about the Beatles song, there are 2 remaining Beatles out of the 4. They don't have rights to a bunch of their songs. As a matter of fact, the Michael Jackson estate owns the rights to a bunch of Beatles songs. So, wait a minute. So if the Beatles try to play their own songs, they're going to pay somebody? Yeah. The happy birthday song, why does a restaurant like Applebee's say, they're going to sing you happy birthday? They sing happy, happy birthday, happy, happy birthday. They don't sing happy birthday to you. Happy birthday, Mr. President. They're not singing this traditional song, because if they sang the traditional song, they'd have to pay somebody because they're getting commercial benefit from it. So that means that they're going to make up a song and don't have to pay any royalties. So patents last typically 20 years. Piece of paper, it's a right. Now, I'll tell you, the patent that's on the vaccinations right now, I'm guessing for COVID, aren't going to last 20 years, practically. Legally, they last 20 years. But as a practical matter, in a year or 2, they're going to need new vaccinations. It's going to be new variants, new versions. So make it 2 years life out of it. It's 3 years life of this vaccination. So legally 20, but they're probably going to take it as a 2-year or 3-year. Copyright, 75 years past the death of the creator. So when did Tolkien die? I think well, less than 75 years ago. So Lord of the Rings is still in the rights with his estate. But if you got Bach and Beethoven and Mozart, they're over 75 years past. So you can use those copyright royalty free. So non-current assets without physical substance often provide exclusive rights or privileges. Useful life could be difficult, like goodwill, usually acquired for operational use. So here's some choices: patents, copyrights, franchise agreements, they typically last 10 years, 5 years, 20 years. Trademarks, trade name, goodwill, we do not amortize goodwill. Right of use asset, leasehold improvements, R&D, research and development, other intangibles. So in sharing those, I want to point out that when you make the adjusting entries, you debit the amortization expense and you credit the asset called patent, called copyright. You will credit directly the asset. There's no accumulated amortization expense. You'll see that. And then the last thing I'll mention before we part company is our asset turnover. You remember receivables turnover, net sales over average AR. Our asset turnover is net sales over average total assets. So if I said I had $10 million in sales and $2 million in assets, my millions cancel, my dollars cancel, I get a turnover of 5. That means I sold my assets 5 times. My average assets. You don't put the assets in the numerator and the 10 in the denominator. That's 20%. I didn't sell 20% of my assets. I sold all my assets 5 times. And that's our asset turnover. One of the ratios you're going to be responsible for knowing. Going to ask any remaining questions before we part company. And if not, I look forward to seeing you on Friday. Have a good rest of the week.